Monday's U.S.-China trade talks in London set the tone for mortgage rates this week. Now, one positive headline could send yields down, one misstep could push them up. Welcome to this week's market update, where we help you stay ahead of the curve and win in any market. Here's what's to watch. Stocks ticked higher and mortgage bonds held near flat on Monday, and both started modestly higher on Tuesday. They're awaiting updates from the U.S.-China negotiators. And here's this week's big events. There's two of them: Wednesday's Consumer Price Index and Thursday's Producer Price Index. These are the big inflation reports. So last month's core inflation reading was for April's data, and it showed just 0.2% month-over-month inflation, which is great. But this was before the tariffs impact was likely captured. So this week's numbers will be for May's data, and it may have tariff-driven upside surprises that could shake the market. So although the short-term rate outlook is a little volatile, there was a big positive development. The first step toward bank deregulation happened this week. You see, if banks hold risk-free treasuries without impacting capital ratios, lending becomes easier, reducing yields. Experts predict about a 10 to 70 basis point drop, benefiting mortgage rates. Fed's new Vice Chairman Bowman, sworn in on Monday, supports this. So we're going to watch this closely over the next several months and report back. Technical signals remain bearish. Bonds broke key moving averages Friday, and yields have room to climb before finding new ceilings. So buyers under contract closing in less than 30 days should consider a locking bias. Monitors this week's inflation data closely. Inflation surprises to the upside could be too late to protect your rate. That's when we have a locking bias. Sellers are seeing active listings tick up, and buyer demand is slowing down. So to stand out, be realistic on price and lean on seller buydowns. For example, rather than making massive price cuts, consider funding a seller buydown to preserve your equity and give buyers immediate payment relief. Watch last week's update for a deeper breakdown on how this strategy bridges that pricing gap. We are still in a prep phase. Tariffs and trade negotiations keep rates hovering, and sticky shelter costs are still a wild card. So we're all in this together. Your edge is being prepared. Get your FastTrack approval, know your must-haves, and lean on a temporary buydown for breathing room if needed. Secure a home with a strategy built for the next 3 to 5 years, and you'll come out ahead, no matter where rates land. If you were a seller today, would you fund a buydown instead of a price cut? I'd love to hear your answers. Drop your answers in the comments below. Wherever you're at in the process, let's connect to ensure you're offer ready. Stay tuned, stay ready, and as always, be the Buffalo. Thanks for watching, and we'll see you next week.